Good morning, good afternoon, and good evening to all of you, depending on where you're watching us from. And welcome to the Ion Influencers Fireside Chat, where we speak to the sharpest minds from the world of capital markets. I'm your host, Giovanni Amodeo, and today with us, we have Heath Zarin, who is founder of EmergeVest. And the topic of today is industry-focused supply chain investing and secondaries as well. So thank you for being with us, Heath.
Pleasure to be here, Giovanni.
Fantastic. So maybe let's start with your background first and how you founded EmergeVest.
Sure. Thank you very much for the invitation to be here today. As you said, I'm Heath Zarin, founder, chairman, CEO of EmergeVest. I started my career as a corporate lawyer in New York with Schulte, Roth, and Zabel, forming and advising hedge funds and private equity funds. I then joined DLJ Merchant Banking, which probably dates me. At the time, DLJ Merchant Banking was a very successful leveraged buyout investment business as part of an investment bank called DLJ. And at that time, the world's largest LBO fund had a whopping $3.5 billion of capital commitments in it. So anyway, Credit Suisse First Boston, as it was known at the time, acquired DLJ. And that gave me an opportunity to begin to invest internationally, first in Central and Eastern Europe, and then in Asia. So I relocated to Hong Kong in 2005 to start and run Credit Suisse's Asian private equity business, which I did for a few years. I then had my own investment business during the GFC, which was a precursor to EmergeVest. I then was with HSBC running their principal investments business in Asia for a few years, and then left HSBC to form EmergeVest. And when we formed EmergeVest, we thought to ourselves deeply, why does the world need another GP? Why does the world need another financial sponsor? And our answer to that was that we were going to focus on operations in specific industries of interest. And for us, we chose the supply chain sector, which is a fairly broad and dynamic sector. And here we are 10, 11 years later, and doing okay.
Why did you choose the supply chain as a niche to invest in? What was the thesis that you pitched to investors?
Sure. Well, first, supply chain as a sector isn't really a commonly recognized sector by itself. So our strategy is to invest in businesses where they're related to a supply chain. And by optimizing supply chain and having supply chain knowledge, can add to additional value creation. That's most obvious when investing in businesses that provide services that are related to supply chains, such as logistics services or technology businesses that are in that sector. And so then specifically within the logistics sector itself, we find it to be attractive for many reasons. One, it's a very large share of the global economy. It's a highly fragmented market where some of the global leaders command single-digit market share. And the fact that it's a highly fragmented market is attractive for a few different perspectives. One is it's possible to grow faster than the overall market by taking share away from other competitors. And also it lends itself to a buy and build strategy where you can invest in a business and then continue to make acquisitions to power it forward. In addition to the structure of the market overall, our thesis was and continues to be that as a strategic supply chain services provider, you're really important to your customers. And although there may be a view from the outside looking in that it can be more of a commoditized type of business, we view it as being really sticky. And so in some ways, you get the recurring revenue dynamics of a software and a technology business in a pure services environment. We also see a few trends that were ongoing 10 years ago and are only gaining speed these days. Increased outsourcing to the sector, which provides growth for the growth for the market overall. Digital transformation, and so technology, software, robotics, AI, all coming into the sector. And so having that as part of your toolkit as a GP makes it an attractive place to invest. And then one other very important long-term secular trend is ESG, and specifically sustainability from an environmental perspective. And so being able to do things that will create value while also helping the industry to be greener overall. There are other factors, but I'll leave it there for right now.
So let's consider in supply chain some of the macro factors. So what happened in the Red Sea or the semiconductor crisis that we saw 3 years ago? How do you factor in all these macro factors into your investment thesis? And how long are you in those?
Sure, that's a great question. I think if we talk a little bit about the impact of ocean freight or sea freight dynamics, and we've invested in freight forwarding businesses, international supply chain services businesses for more than the last 10 years. And so we've seen different aspects, different parts of the cycle. When underwriting a new investment, we will use our in-house view of long-term pricing and long-term GP, general profit in this case, in terms of what we believe is financially sustainable for a potential acquisition, a potential portfolio company to achieve over a period of time. Then one of the lessons of COVID is to be even more severe with your scenario testing. And so you have to be quite extreme in that way. And so we tend to have a conservative approach to leverage, which would then allow our businesses to deal with more ups and downs and dynamics, bringing it more current now in terms of the Houthi rebel disruption to the Suez Canal. It's been something which we've been very active in our existing portfolio, working as part of the management team in order to ensure that we are providing solutions to the portfolio company's customers in turn. And the best way to manage risk is to assume the worst. And so for those who are not aware of it, previously a very large portion of global containerized freight would move through the Suez Canal. That's no longer safe, and many shipping lines are not using that for voyage. Instead, they're moving from Asia to Europe, around the southern part of Africa, the Cape of Good Hope. This extends transit times, TT in industry speak, meaningfully. It also causes equipment to be in the wrong places, very reminiscent of the disruptions that occurred to global supply chains during the bounce back after the COVID pandemic or the surge in demand at that time. And so now you have to deal with a very dynamic and difficult sea freight environment where it's challenging to secure capacity. Pricing is going up seemingly all the time. And so you have to use technology and strong execution at the management level of portfolio companies in order to ensure that you're being successful. That's not the only disruption that has occurred in supply chains recently. The Ukraine war, the breakout of war in Israel. I think that some statistics say that supply chain disruption now occurs every 3.5 years or so, maybe even more frequent than that, and can wipe out at least half of a company's earnings over that 5-year period of time. And so one of the other ways that we use our knowledge of supply chain is with businesses that are not directly in the services sector, but have a dependency on supply chain for themselves, whether they're a manufacturer, a producer, or a retailer. The knowledge that we have at EmergeVest on supply chain disruption and resilience is something that we use for value creation in those opportunities as well.
You talked about these increases in prices. Can you pass them on the customer in the short term, but then what's going to happen in the long term?
I think at this point, unfortunately, the situation in global logistics is that price increases need to be passed through. And there's a recognition and awareness of that of all stakeholders. There's a view that perhaps ocean carriers are profiteering a bit from these dynamics today, but it is what it is. It's microeconomics right there on display. If we want to move a shipping container, we have to pay the price that is needed to move that shipping container, and in turn, our customers have to then pay that price as well. And there's looking ahead, very likely there's going to be new highs set into new highs in terms of pricing, at least for the spot market in containerized freight. Many people don't know that there actually is a paper market for containerized freight, the Shanghai Container Freight Index, and others. So it's possible to make financial investments and financial plays in futures in this container space. And one of the things that we're studying at EmergeVest is whether the disruption of recent years is going to lead to a larger growth in that market, in that space, where historically it's been relatively small as a percentage of the physical trade itself.
And how do you want to take advantage of that, or can you or others take advantage of that?
I think that if, to the extent that there's a new financial market, a new space coming online, then it provides opportunities for arbitrage, perhaps, and it also provides meaningful opportunities for hedging. And so we're aware of customers that will take some exposure to long-term contracted freight rates, and then we'll also take some exposure to that spot rate as a way of balancing their risk. And that's something that we also advocate for some customers directly as well. But it might create additional opportunities for pure financial operators in the future as well.
You talked earlier about the sustainability, and one of the big topics now is how to make all your supply chain sustainable. What are the things that you do at EmergeVest on that front?
Sure. It's a very challenging thing to take what some people perceive as being a more dirty or heavy polluting industry and help it become green. So you take a step back, we're talking about logistics services and transportation services. It involves the movement of goods by air, sea, road, rail. All of these options consume energy and emit greenhouse gas. They're not all the same, though. There are some which have a much heavier carbon footprint, such as shipment by air. However, within logistics, being more efficient and getting more, not transporting air, but transporting goods as opposed to empty boxes is a win for all stakeholders. It reduces the cost, it reduces the negative impact on the environment, and it also increases profit. And so we focus in the first instance by being as efficient as possible. At EmergeVest, we have a system called EVOS, the EmergeVest operating system. It's our value creation process that spans the full range of private equity investing. And so within portfolio management in EVOS, we have a number of different plays in our playbook. And so one is fewer and friendlier miles. So in general, when looking at supply chains, we try to be as efficient as possible, reduce the amount of miles, and make them friendlier, i.e. have a smaller carbon footprint by having higher fill, whether it's a shipping container, higher fill, whether it's a truck, or using fuel efficient, new fuels that are more efficient. So we have a portfolio company named Pallet Force. Pallet Force is a specialist in less than truckload freight. By operating a network of 120 plus different trucking companies, we are able to allow all of those trucking companies to reduce their carbon footprint by getting higher fill on their transportation needs for less than full truckload assignments. In a different part of our portfolio, in EV Cargo, we have a subsidiary named Solutions. And in that business, we've experimented with and are using alternative fuels such as HVO, hydro, vegetable oil, which can reduce carbon footprint by more than 90%. We've trialed electric vehicles, which are still a bit too expensive right now, in need of more government subsidies and support. And then we also have a program where we combine a few different modes together, such as sea and air, in order to reduce some of that footprint. Finally, rail is a really good option for reducing the carbon footprint from moving goods. If you then go and look into the physical side of things, whether it's a large warehouse or logistics facility, there's no shortage of things that you can do to be friendly to the environment, from the use of solar, more energy efficient lighting, and the like.
Is carbon footprint your main metrics that you're looking at, or are there any other metrics?
So we're signatories to the UN PRI, Principles of Responsible Investment, on behalf of EV Cargo, which is our flagship portfolio company, where I also serve as CEO. We've signed up directly with for the UN SDGs as a portfolio company signatory. So although environmental considerations are probably the one which is most widely talked about across the industry, our approach is much more comprehensive than that. So we focus on diversity, inclusion, and equity, and we're a signatory to OPA's initiative in that respect. And so, for example, in our portfolio companies, we've increased the percentage of women in senior management from 16, 17% to more than 25%. We're very focused on being an inclusive employer for our portfolio companies to accommodate all different types of work from home flexible arrangements. We also focus on being a positive stakeholder in the communities in which we're active. So having programs and initiatives to raise money for local charities and to give back to the communities in which our portfolio companies operate. So we use the balanced scorecard as one of our metrics, and the balanced scorecard has 4 different dimensions: shareholder dimension, customer dimension, operations, as well as growth and innovation. And so within that spread throughout, we have a number of different KPIs that we track for our ESG performance.
We've seen the news last week that in the US, some large companies have abandoned their D&I metrics and targets. Do you think this is going to have an impact in Asia and Europe as well?
I think so. I think there is a pushback against against diversity initiatives. There's also a bit of a pushback against greenwashing as well. And so doing things for the sake of doing it, where it's not linked to the underlying value creation, is always a risky proposition. So for us as a business, as a MergeVest, we have 3 core values: growth, innovation, and sustainability. And we often say that for us, sustainability begins with financial sustainability. So all of our sustainability initiatives and plays, and I use sustainability as a catch-all for ESG, all of our effort in that space starts with being sensible from a financial perspective, and then extends out in order to achieve and take progress against the UN Sustainable Development Goals. So if you bring that back more specifically to the question, we fundamentally believe that having a diverse workforce and a diverse management team results in a richer discussion and better decision-making overall. It doesn't mean that we're going to go out and remove one cohort from our teams in order to replace it wholesale with another. These things take time. But by being a diverse and inclusive and equitable employer, you should end up being more successful at recruiting, developing, and retaining talent over a period of time. And we invest a lot in services businesses where people are your main asset, actually. People, it's the people that create the technology that runs the business. So although there's a bit of a pushback against it, I do think that it still makes fundamental sense if you're doing it correctly, which is being focused on being a responsible investor overall.
So the second part of the discussion is around secondaries. So we heard from a lot of people that we had a peak in 2021, 2022, with the value of 120, 130 billion, depending on how you're looking at it. Now we are plateaued. What do we need to get to the next level in the cycle of secondaries, in your opinion?
Sure. I think if you take a step back and look at the growth and the development in terms of sophistication in the private equity secondary space, it's really impressive. And so my personal interaction with secondaries began in 2000 with the creation of Strategic Partners, which is now part of Blackstone. That business started at DLJ back in 24 years ago. And so at MergeVest, we've been a student of secondaries for all this time. And we've used the GP-led architecture for fundraising from our earliest days. If you look at the ecosystem today, it's just really flowering and developing in many different directions. And what I mean by that is the growth in secondary firms has been very strong and broad. The increasing specialization in terms of pools of capital that are focused on LP, GP-led, single asset, increasingly now being focused on specific types of investing within those categories. The expansion of the investor universe to be not just secondary funds, but to be all manner of direct investors as well. And finally, the expansion in the advisor community, where you have a real growth where previously you would have fundraising groups that did primarily primary placement, a little bit of secondaries. That secondary side has really grown and extended. And now you see most investment banks, most M&A advisors extending into that GP space. And so I think right now the next leg is going to be powered by a broader understanding that GP-led opportunities is not a second-class exit, but that it can be a primary way to deliver value for all stakeholders. Oftentimes, there's a perception that in the secondary space, the pricing is not as strong as you would be able to achieve if you're a seller into the market, as compared to traditional M&A exits for using the GP-led single asset transaction type as an example. I'm not sure if that's going to continue to be the case because there are certain advantages that the GP-led single asset space has as compared to a sale to a brand new financial sponsor or to a trade buyer. And specifically, it's that risk of change of ownership, where when you have an incumbent GP that is continuing on their same value creation journey, one of the largest risks in private equity is removed. And it's often joked with GPs that as much due diligence as you do, you don't really know the asset until day one when you actually own it. That risk is completely removed in this scenario. And then in addition to the GP as a stakeholder from a management team perspective, that continuity of ownership also allows for the management team to continue to execute at a very high level without disruption. And so I think over time, with a recognition that pricing it can also be strong in the GP-led space, and also an expansion in terms of which geographies are focused on. And what I mean by that, the US market is the market where, because of history, is where most of the transaction volume happens. US as a bucket gets filled first. Europe as a bucket will get filled second. And rest of the world and Asia is then filled last. And as somebody who's headquartered and based in Hong Kong, I can see today that China bucket is really struggling to get any drops in it. That will also change as well. And so when you have a more well-rounded geographical diversification perspective, we will see significant growth overall. Well, even more significant growth overall.
Based on what you said, do you think every fund needs to have a secondary fund, or any asset manager needs to have a secondary fund?
I think that you'll see the expansion of the largest fund managers will likely have a secondary strategy of a type. And with some of the largest fund-to-fund platforms, they're now led by their secondary strategy overall. And also, if you think about the size of the private markets, the percentage of exits that occur through traditional means, if 1%, 2%, 3% begin to occur in the secondary market, the market needs to grow much more than it is today. And so that demand for capital always pulls capital. And so that will happen.
Continuation funds. Do you think is a way for funds to say, actually, we should have done better in the holding period, and now it's a way to repair that? Or is it a genuine way to see, okay, there's lots more value to be extracted in this business, and therefore we're going to reinvest part of it?
I think you could probably find examples of both. And so we have a flagship portfolio company named EV Cargo. And we, as a GP, we have a unique connection with this business because we created it. We created it in 2018, and I've served as the chairman and CEO of EV Cargo in the 5 to 6 years since then. And we see and we know that there's a very strong value creation map and path lying ahead. And so we sit here as a GP and we see that we can double or 2.5 times EBITDA from current levels within a 3 to 4 year holding period. And so that's not, those aren't opportunities that are easy to come across and to find as well. And so we see that as something which is really very interesting. At the same time, we need to drive strong returns and liquidity for existing investors and to look at the optimal outcome for all stakeholders involved. And I think that there are also other GPs that will have strong performing assets with more value that they can continue to drive forward out of them. For sure, in the non-control space, where you have a minority investment or a passive venture investment, and you're waiting for an exit to occur, the dynamics might be a little bit different in terms of alignment of interest or objectives.
Fantastic. So a few final questions as we are approaching the end of the discussion. One is on interest rate. How are your businesses going to be affected if interest rates go down, stay the same, or go up?
Interest rates right now are a factor for all businesses that have been taking on debt in order to grow, and we're no exception to that. And so if interest rates go up, it will increase our debt service requirement, impact the amount of cash that we ultimately generate from our investments. We're pretty prudent when it comes to the use of leverage. And so we still are at very modest levels of leverage across our portfolio and have the ability to see interest rates rise significantly further from current levels without having any major issues. However, if interest rates go down, that would be very much welcome. And so because you end up then reducing your cost of servicing your current debt and generate additional cash proceeds overall.
But have you priced the interest rate right now? Are people getting used to that?
I think the current levels have been absorbed. One of the things which is really interesting from a portfolio management perspective is the difference in how to manage working capital at the portfolio company level. So when interest rates were much lower, you could take different views in terms of management of working capital and perhaps the use of extending payment terms for customers in order to grow and increase your EBITDA overall. Now, that's a much more trickier trade-off. And so also if you have working capital set up in a way that was put in place in a low interest rate environment, we then needed to react very quickly with the onset of interest rates going up in order to adjust at the portfolio company level. We've made that adjustment overall, and so that's why we're comfortable at the current levels. I do also think that higher interest rates obviously has a negative impact on valuations overall. It impacts on the amount of leverage that can be taken on for new acquisitions, and so often also has a negative impact on the exit environment. So interest rates coming down would have a positive impact on M&A activity overall, I would expect.
One final question on the brand, EmergeVest brand. What does it mean now, and what should it mean in your ideal scenario?
Sure. Well, at EmergeVest, oftentimes we get told that people think that it's because we were an emerging manager that we use that name, or that we were investing in emerging markets. But it's actually much simpler than that. It's just based off of the word emerge, which means to come into view, kind of suddenly from nowhere, and that it links with our value creation strategy, where we invest in mid-market businesses, help them to grow and to be global leaders. So we help our portfolio companies to emerge onto the world stage. And so hopefully in time, our brand will be known for that.
Fantastic. Heath, thank you so much for your time and your insights, and thanks everyone for listening.
Thank you.